Welcome to Alu Speaks with Alu Patience. Today we will be discussing on the topic financial market. This is going to be our fifth topic in the course Comparative in Finance. If you have not watched our previous topic, I would advise you to do so. However, do not worry. I realize that most of us do not have a business-oriented background. So I'll be breaking this class down to be as simple as ABC. At the end of this class, we should be able to define what is the financial market and the purpose of the financial market, and also understand the participants in the financial market. We'll be breaking down the different types of markets under the financial market and explaining what the purpose of such markets. And we'll end it by discussing the circle of cash flow in the financial market. The financial market. The financial market is a place where buyers and sellers meet in order to trade in financial assets. It is a market where financial instruments are bought and sold, meaning that it is a market that exists to facilitate investment and borrowing. This is a system or platform where people, company, government come together to buy and sell financial assets like stocks, bonds, currency, option, treasury bills, etc.
If you are still here, please like, subscribe and follow. And do not forget to click on the notification button so that you do not miss out on future amazing topics.
Now, let's discuss the functions of the financial market. We already know from our previous class that the financial market is a place where we buy and sell stocks and bonds. We also know too that the financial market is a place where we gather information about new and existing stocks and bonds, about companies and the government that participate in such a market. Since buyers and sellers come to the financial market to buy and sell shares and bonds, which means that the financial market determines the price at which shares are sold in that market. The interest rate on bonds are also set in the financial market. And obviously, because the market price of shares and the interest rates of bonds are determined in that financial market, which means the financial market will have an impact on the inflation of the economy. Since the financial market encourage easy buying and selling among investors, it means what? It encourages liquidity. We have different types of financial markets, and these different types of financial markets, they differ by the types of securities that are bought and sold in that market, and how that the trading on such securities is being done. The buyers and sellers in such market also differs. The different types of financial market, the different subsectors under the financial market, they include the capital market, the money market, the currency market, and the derivative market. The capital market is a market where long-term investment instruments like shares and bonds are sold. That is, instruments that have a lifespan greater than 1 year. And because such instruments have a lifespan greater than 1 year, it goes to show that this is not a very liquid market. However, it is a market of high returns and high risk. The capital market functions as both the primary market and as a secondary market. Therefore, what is a primary and secondary market? The primary market is a market where new shares and bonds are sold. It is a market where companies or government issues fresh shares and bond for sale, and they make dis fresh bonds and sale available through either public offering or through private placement. By public offering, I mean they offer for sale dis debts and bonds to the general public. That is a public offering. When these shares and bonds are offered for sale to the entire general public, it is called a public offer. These public offers, they must be registered with Security and Exchange Commission after complying to all the necessary disclosures, legal disclosures that are binding on such sales. And for public offering, an underwriter is needed. That is, an investment banker is needed. These investment bankers, I mean the underwriters, they serve as an intermediary between the issuers of the new stock and bond, that is the company or government trying to raise capital, and the investors. What they do is that they guarantee the sales of these new securities, and they assess the risk on the sales of new loans and determine the price for such new shares and the interest of such new loans. While the private placement, this is a different type of capital raising platform, because here the debt instruments and shares, they are not offered to the general public like the public offering, but to selected individuals and companies. I mean here that the offering is made directly to qualify the institutions or high network persons to come and buy, to come and invest. The reason why some company prefers private placement is that lengthy registration with Security and Exchange Commission is not necessary, and all those transparency requirements, disclosing so much information, is not required. Apart from the fact that it is a faster method of raising fund, and here you do not need an intermediary, you do not need an an underwriter. The buyers meet directly with the potential investors, and it is a cheaper method of raising capital, unlike the public offering. There are so much costs associated with public offering, because the public offering is heavily regulated by Security and Exchange Commission. So in the public offering, you have fees like the registration fees, the professional service fee, administrative expenses, even corporate affairs commission, registration and filing expenses, and other expenses, so to speak. These add up and make the general offering more expensive than a private placement. You know, we said that the primary market is a market where new shares and stock are bought and sold, which means that the secondary market is a market where old shares and bonds are bought and sold. It's where old securities are exchanged between one another. Here, it is not only companies and government that are doing the selling. Even individuals who already own stocks can also sell stocks in the secondary market. That it is a market for already existing shares and bonds to be bought and sold, to be transferred among interested parties. What we are saying is that securities and bonds that initially originated in the primary market, when they want to be resold, is done in what? The secondary market. You know, we said that the capital market is a market where we buy and sell long-term instruments, which goes to show that the money market is a market where we buy and sell short-term financial instruments. That is, instruments that have a lifespan less than 1 year. And since they have a lifespan less than 1 year, which means it is a more liquid market than the capital market. Funds can be easily converted into cash. Instruments can be easily converted into cash faster than the capital market. It is a market of lower returns, and which because of the lower risk in such instruments. Examples of instruments traded in the money market includes treasury bills that are issued by the Central Bank of Nigeria, commercial papers, certificate of deposit, etc. We will not, there are so many. We will not be going into that in details. Now, the currency market. The currency market is is the foreign exchange market, or we call it the forex market. It's a market where we exchange currency. We trade in currency, like exchanging the naira for the dollar and vice versa, other currencies. It's a market where we exchange various currencies. This market is facilitated by international trade and speculators trying to cash in the difference in currency rate conversion. The derivative market, this is a market where contracts are bought and sold for their values. Examples are futures and options, but we would not also be going into details into that because it seems to be outside the scope of our topic today. Now, let's circle back to the capital market. Like I said, in the capital market, we have both the primary and the secondary market. And in that secondary market, we have the dealer market and the auction market. Let me explain. The dealer market is a market that is controlled by middlemen. Here, middlemen buy and sell securities using their own money. They hold securities down like inventory, like stock, and they set price, that is the bid and ask price, on those inventories they bought, and they make a quote for potential investors to come and buy from them. What I mean here is that there is no direct trading between buyers and sellers. Investment banks act as middlemen. They buy up these shares and bonds from companies and firms and resell it to potential investors for a profit. While the auction market is a market where buyers and sellers trade directly with each other. There is no intermediary. There is no investment bank acting as an intermediary between them. Here, the price of the shares and bonds is determined by demand and supply. That price is determined by market force. Unlike the dealer market, where the price is determined by the intermediaries who set the ask and bid price. This is an order-driven market. So we can easily see the difference between the dealer market and the auction market. The dealer market, trading is done through middlemen, while the auction market, it is direct trading between buyers and seller. And in the dealer market, the dealers, they fixed set price, while in the auction market, price is determined by market force. The dealer market, the dealers, the dealers are the one that hold the securities that are being sold. While in the auction market, the real owners of the security of the instruments are the one who hold their instruments for sale. So the dealer market is a quote-driven market. The price is quoted, while the auction market is an order-driven market. The price is determined by forces of demand and supply. From the discussions we'll be having, it is now easy for us to determine who are the participants in the financial market. One, the individuals, the investors who have surplus funds to invest in the financial market, or who have existing shares to resell in the financial market. We have the companies who issue initial public offers and bonds in the financial market. And also, we also have the government who also issue bonds, long-term and short-term bonds in that market. Also, we have players like the banks, who are intermediary, like the investment banks. They act as intermediaries in the financial market between the buyers and the sellers. We also have insurance companies. Insurance companies, these are companies that insures the bonds and risk, or the bonds and shares on behalf of the sellers. We have the mortgage companies too. They are there to sell debt instruments through mortgage to both companies and individuals who are interested in a mortgage plans. We also have the pension fund company who invest the pension fund gathered into risk-free investments on behalf of their customers. That is on behalf of potential pensioners. So looking back at the various types of markets and the various participants in this market, we already understand there will be a cash flow from these various participants and various markets. So let us give a scenario of how cash flows inside the financial market. Investors and lenders with surplus cash go to the financial market to buy financial instruments, that is financial assets, from firms seeking capital to boost their project. These said firms, they sell these financial assets to the investors and lenders that have surplus cash, and they get a return on this capital they have raised. The return gotten by these firms is used to pay dividends to these investors. It's used as retained earnings to be reinvested in other financial instruments or other projects. It is used to pay interest on bonds, and the circle goes round and round, starts over and over again.